Let's now turn to the advisory and how appropriate is debt recycling as a tax-effective strategy. Glen Hare is joining us from Fox and Hare Financial Advice. Glen, welcome back. Good to catch up with you again. So when we talk about debt recycling, now this is what, using equity in your home to invest in income-producing assets.
Yes, but I'll expand upon that. So debt recycling is something that's coming up a lot in conversations at the moment. I don't know if it's reading books, listening to podcasts, but it's something that's getting a lot of airtime. And in terms of what debt recycling is, so it's not quite as simple as just using equity in your property. And the reason I say that is, in order for it truly to be debt recycling, we need to recycle something. So if we've got hypothetically a $1 million mortgage, so a home loan, so typically non-deductible debt, and we've got, let's just say, a stock portfolio sitting to the side worth $100,000. If we sold out of that stock portfolio, paid down $100,000 of that non-deductible debt, we then redrew that $100,000 and then reinvested back into the stock market. What we've essentially done is reduced our non-deductible debt from $1 million down to 900, and then taken out a loan of $100,000 being an investment loan to then invest into the stock market, which would be deductible. So in its truest form, debt recycling is where we've taken something and recycled non-deductible, in effect turning it into deductible debt.
What is the risk in doing that?
The risk. So good question. So there's three risks, or certainly considerations that I'd love everyone to think about. The first is that if you are borrowing to invest, which in a sense we would be, we need to be mindful that our investments may underperform or lose value, which could leave you with that debt burden and a reduced asset base. The second is interest rate fluctuations. So I am mindful the general commentary at the moment is that interest rates will likely drop off a couple of points over the course of the next 6 months or so. That won't always be the case. So if our interest rates are going down and we take out debt based on those assumptions, we do need to be mindful at some point that may turn around. The other is just simply the complexity and the documentation required in order to prove to the ATO that in fact this is an investment loan. So as a kind of a side tip there, I'd want to be making sure that if you did take out debt for investment purposes, you're structuring your debt in such a way where it was a separate lending facility, so that when you go to do your tax return, you can very clearly articulate that, yep, this is my existing home loan, and this additional $100,000, using my previous example, is the interest charged on that is deductible. So they're the downsides. There are some obvious benefits of this strategy as well. The first and the primary advantage is tax efficiency. So the ability to claim deductions on interest on your investment loan naturally reduces your overall tax liability. The opportunity to use that tax savings in order to expedite those debt repayments, so using the tax savings on that deductible loan to potentially further accelerate the repayment of your non-deductible debt or your home loan. And the broadest one and the most, pressing one is overall wealth creation. So this strategy does allow you to build a diversified investment portfolio and grow your wealth sooner, taking advantage of those tax concessions.
So you're saying the primary objective there would be to pay down your mortgage, as you say, because that's non-tax deductible. So get rid of that debt.
Correct.
And start making money on your other investments that you have taken a loan out for.
Exactly right. So thinking about, again, that case study, we started with $1 million of non-deductible debt, our home loan. We have then reduced that to $900,000 and then borrowed $100,000 to invest. So our overall debt position has remained the same. But what we've done is changed the makeup of that debt, meaning 900 again being non-deductible and 100,000 being deductible, over reducing our overall tax liability, but also diversifying our wealth again away from our primary place of residence.
So, Glenn, does this only work if you have a large asset such as a home, because it involves using that equity?
Yeah, exactly right. So we've got to have non-deductible debt in order to utilise this strategy, which for most is the family home.
How practical is it to apply this? And is there any particular stage in life where you're doing it with your clients, for instance?
So for those that have the family home, but they've built wealth outside the family home as well, so they've got considerable cash savings as an example, or they've built a stock portfolio again outside the home, regardless of whether it's $50,000 or $500,000, you can still utilize this strategy, obviously, to differing advantages. But essentially, if you've got a family home with non-deductible debt and you've got assets outside the family home, you could use those assets to pay down that non-deductible debt and then redraw against that family home as an investment loan. So not changing the overall level of debt you have, but again, changing the structure and the makeup of that debt to then reinvest back into the stock market or investment properties.